At the beginning of the move, the buy program, as we've been outlining in this lecture series, the idea was that we were expecting price to potentially trade up to those relative equal highs over a longer period of time. So the buy program starts here, and we had obviously some consolidation down here, which is accumulation, and then we have price running through this old high. Now, classic support resistance theory would say, okay, this is an old high broken here, and if price comes back down to that level, I want to be a buyer. And that's what all the books that I bought said. Many times I tried to do that, I lost. This is the reason why what we teach is not supply and demand. It's not classic support and resistance. It's not break and retest. It's none of that stuff, okay? It's deeper, as you'll see. So the logic is this high being ran out. That's fine and great, but I want to know where's it going to go to, because there's many times the market won't even come back to this old high anyway. But if it does, what am I personally looking for? So the buy program starts here, and that low is the first primary reference point. So we have this low up to this high. So there's our two key price levels. So between this high and this low, we have to run a PD array matrix. So you have to find out where equilibrium is. So we have a very bare minimum of price trading back down to the 50 level. So we were bullish on euro, and once it trades to this price point here, that's indicating that the market is at equilibrium, or while bullish, that is discount. Okay, so at equilibrium or less, and it's bullish, that is a discount market. So at that price level here, we have to start looking at that level and below for all discount arrays. So right away, we have relative equal lows here. We have a buy side imbalance, sell side inefficiency. We have a bullish breaker, last up close candle here, and mainly the imbalance right there. Okay, so watching this low right down here, that's, well, not low, but that high rather, that's what we're going to focus on. That would completely close in this buy side imbalance. So what are we looking at? What are we seeing here? What we're seeing is the initial stages of a high resistance liquidity run, even though the market is bullish. Why is it high resistance? We had a market trade high here, then a higher high, then a higher high. So we had basically a three Indians pattern. All the highs are successively higher. So this was all running out liquidity, specifically seen as a return back to this displacement right here. So it returns back to rebalance, but don't lose sight of this signature here, because this is high resistance. For now, just know that this buy side delivery, it's running price higher, going to buy side liquidity here, but it's offering buy side delivery, running into buy side liquidity here. That's why sometimes when you hear me talk about, okay, it's going to run to buy side liquidity, a neophyte trader or someone just watches a hand-me-down video of me talking about runs on liquidity or relative equal highs, they assume erroneously that just because it runs above that, it's running out stops to go the other direction. No. This buy side delivery, it's imbalanced. It's only been offering buy side, so it has not offered efficiently any real opportunity for sellers to trade short or offer in this range between the high here and the high of this candle, what's being highlighted with this blue line. Each high here, we have buy side liquidity here, it runs it. This high here has buy side liquidity, which it runs it as well. And then it breaks down. What's actually occurring there? This is a shift in market structure. It is not a break in market structure. Okay, it's just shifting within the context of an underlying buy program. So this low, when it was broken right there, that shifts market structure to bearish, but only on the near term. Why? So it can go back down below this low to rebalance this buy side imbalance. Before it trades down there, it trades back up into a premium fair value gap. Once it rebalances that, then it's okay to see it trade lower. It trades down into that old high, which is retail resistance turn support. Does it rally? It gets a little sputter there. Then it goes a little bit lower. goes up one more time, and then drops aggressively here. So what is this occurring? It's offering a run on the liquidity that would be engineered right below these lows. But price trades down into the imbalance and then runs higher. Trades above this high. There's your short-term shift in market structure. Now, I don't have it identified like it does here, but this is a shift in market structure to the bullish side. What's different about that? This is short-term down to a discount. This right here is a change in the state of order flow. So there's an algorithmic transition from buy side, the market's offering buy side, and then it goes down into that buy side while it's acting as sell side. Okay, so there's a change in the state of delivery in the price where it was offered on sell side here into an area where it was only buy side. When you have that happen and the narrative is bullish, this is where the signals form. This is how you quantify the buying opportunities, whether it be a breaker, whether it be a fair value gap or an order block. The fact that the algorithm is going into an area where the state of delivery is changing to a previous state of delivery. And it's basically saying this: where there was buy side offered only, when it drops into that as sell side, that is what keys up the algorithm, and it matches up sell side delivery in an area when there was only buy side. Once that occurs and the narrative is bullish, that's when price will change on a dime and start going up. That's how you've been able to see me do these examples where I'm recording and I'm buying and it's turning right on a dime and it has very little drawdown. I'm teaching you that right here. That's what this lesson is. I'm teaching you the internals of why order blocks and imbalances constitute a setup. It's not just it's trading to an old candle. There's logic behind that. And you have to know what it is that it's doing. It's not just simply, oh, it's going back to the order block and we'll just keep it simple. No, the fact that it's got an imbalance here, why does it need to go down there anyway? Because this is efficient delivery of price, and this is what traders are looking for. They are not buying this and then driving price up because they bought it. The algorithm is already going to go up from this point here. Traders on an institutional level may miss this opportunity. That's the part you don't understand. What I'm showing you right here is the internals of what makes that algorithm do what it's doing. How does it reprice higher? Once it does its job of rebalancing the buy side, once it does that as it goes into sell side. So it's basically saying this: the candle goes up on one singular candle. That's not efficient. But look what's doing here. It's going down multiple times, okay, in a stage where it goes down a little bit, consolidate, down a little bit. It's offering and spending time down there where sellers were being offered the opportunity to get in there. Why? Why would they want that to happen? Why does the algorithm program to do that? Because traders are going to see this as a bear flag. They're going to want to go short, okay? They're going to sell more. Not just the sell side liquidity here, but they're going to flood the market in all of this because they're going to chase it, thinking it's going to drop lower. So they're pushing all kinds of traders' sentiment into thinking it's bearish, 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 when it's nowhere near bearish. It's all bullish. So you have to look at the contrast between what is the imbalance and how does it trade there. It changes its state of delivery, not a singular one candle down like it does here. It's doing something. And you have to think about, what is it doing? What I just outlined here. It's putting in more sellers. And once it does this and rebalances, the algorithm is not aware of how many people bought or how many people sold. It doesn't know that. It doesn't know your specific stop. They don't have that there's no book like that, okay? The idea is everybody's stop is going to be where everybody's stop is, because everybody's drinking from the same pool and the water's tainted. Price starts to reprice higher and it cues all the traders that will be waiting for this signal here that is aware of what the algorithm's doing. Once they see this break here, that's a shift in market structure on the bullish side. Now, again, what changes? We are now in alignment with the buy program after it's been rebalanced and overcome this impulse of sell side liquidity. It's been flooding the market here on two levels. with buyers trying to buy here and they run at, or they go down and then go down again, rebalancing this buy side area here. So it's not like usually you expect like a single up candle and then over here a single down candle and it rebalances. It can happen that way, and that is usually a consolidated range environment where it'll rebalance like that. But generally a strong trending market, you'll see something like this many times if you drop down lower time frames and you look inside this imbalance. So what may not be showing on a hourly chart here, this same thing could occur in a 15-minute chart where it's drops and then drops again. So it's giving a trap basically for traders that want to chase it going lower, thinking this is a bear flag and they're going to look for it to go down in here or maybe into these levels or this old low. So the market starts to trade higher as a result. And then we have to go back to this old high, which is a high resistance liquidity run signature. So notice what happens here. The algorithm goes real close to it and then drops. So it's a delayed delivery above here, which is exactly what you expect in a high resistance liquidity run. So while this is going up, it's going to be met with a lot of tug of war back and forth before it clears it. Okay? So watch what happens. When you see these failures to go above a high resistance liquidity run and it starts to retrace, your eye should immediately go to wherever there's an imbalance, because that's why it's going down there. Or it's going below a short-term swing low. Well, there really isn't a swing low of any importance here that I like that isn't really pushed to the sidelines because of this clear, obvious buy side imbalance, sell side inefficiency. So you can see the discount fair value gap here. Why is this a discount? From this low to this high, 50 is equilibrium. We were below it, and it's rebalancing. So the bottom line is all we're doing is giving structure and context as to why price should be delivered as it is. But look what's happening. The same thing that's occurred down here, there's a change in the state of delivery. Buy side imbalance, all of this right here is the same thing all this was. This drops down, and the fact that it drops down into this area here, there's a change in the state of delivery. But it's referencing an old delivery where it's been buy side only. So where do the signals form? Where do the order blocks? Where are the fair value gaps? Where's the breakers? Where do these PD arrays? Where are the ones that work? How do you figure out what they are? When the market trades down into it, that sell side delivery of price into a buy side imbalance, that's when the algorithm will reprice and go higher. Now this one overshoots a little bit. Now this tail on this candle, if you go through TradingView and look at all of the different data feeds, you'll see that this low is different pretty considerably across the board. And if you have live accounts, look at your own low there as well. And you'll see there's a discrepancy between what your low and all these other lows will be, because this is a run on liquidity. That's the part that makes this difficult, because everybody wants it to stop exactly at that high when it's not necessary. All we needed to do is trade into the fair value gap, and we allow for it to trade down below this low. Now that may be more pips than you're willing to assume. Well, then don't trade the 60-minute chart. Wait for it to close it and then create another fair value gap or a bullish order block on a 5-minute chart or a 1-minute chart, and you'll capture something in there. Then price runs above. The delayed delivery is now ran into buy side liquidity here above this high. So once it hits that, what happens? We refer back to what? This is a high resistance liquidity run. So it does go above it, but look what happens. The market changes its state of delivery again, goes back down into the bullish order block, hits it one more time, and trades to the top of what? The fair value gap. They do not expire outside of the range of the ICT data range. That's how I stop looking at them. Now, if they become sensitive again because of price action and recent delivery, then I'll start following them if they're outside of 60 days. If they're older than 60 days, but they're starting to show sensitivity again, then okay, fine, they're going to be reclaimed. But I don't like to look at a PD array above 60 days and expect a lot of sensitivity. It can happen, but I don't choose trades around that. And that's why we have ICT data ranges, 20, 40, and 60-day look back. But the fair value gap, it trades to here, finds the support with an order block, optimal trade entry. So what's the narrative still? Are we bearish? No, we're not bearish. We're bullish. So the market starts to deliver price on the upside again. Goes above this short-term high, and then what happens again? Another retrace. What's it retracing to? The order block, which is that down close candle right there, and that fair value gap. The state of delivery here is buy side only. What does it do? It trades down into it. The sell side, at the time it trades into the imbalance of the buy side, at that moment, the algorithm changes gears. It shifts. It changes its state of delivery. It's not buying pressure. The market makers were turning price at that. They stopped offering lower prices because they knew how far they were going to take it down to. It was all manual then. Everything was manual. It was a group of men that would literally sit around and say, okay, we're not going to offer any more pricing lower. That's it. And then they would start offering prices higher. And then you, as a trader, see that and say, oh, they're bidding it up. Who's bidding it up? The traders. They're buying it up. That's not what's happening. It's they're controlling it. Whose storehouse is this? The market maker. Well, if we're talking about currency, who's the storehouse owner? The central bank. So whatever price they offer, that's the price feed that everybody deals with. Okay? So if you have a broker or a dealer, that desk has to work with the price that's been given and piped into them. They have no control over where that price is going to go. The only control they have is the spread. They can make that as wide or as narrow as the law will allow. But they have no control over the delivery of where that price is going to go ultimately. This is what I'm teaching you here. We have consolidation here. Market runs up and we have a breakdown. This is a market maker sell model. What? Yes, this is a market maker sell model. But remember, the sell model can sometimes reaccumulate over here and not run out the original consolidation. Oh, that's all part of this same fractal as well that supports the narrative. But then you have this market maker buy model. Consolidation, breaks, returns to consolidation, smart money reversal, low risk buy, reaccumulation, another level of reaccumulation, and boom, clears the original consolidation out. Everything will start to dovetail once you start putting the pieces together modularly. You have to do it bite size. You cannot eat the elephant with one gulp. You got to take one bite at a time and expect to spend a lot of time. You're learning the most difficult thing on the planet because you're standing in front of yourself saying you can't do it or it's too hard. But you have to do it every day. Go into your charts, really annotate them, study them, think about why would it have done something like this, and why is it doing what's doing over here? What's it trying to do? Okay, and then look for when the state of delivery is changing. Okay, when it's opposed to the underlying narrative, it's bullish back here. It's bullish right here. It's here and here. Every single time it's trading down into an area where there was buy side delivery offered, and the delivery is changing its state to sell side and overlaps with that moment when it was buy side. That is efficiently balanced. That means at that moment, that's when you anticipate the algorithm changing gears. Not buyers are coming in or sellers stop losing momentum or start losing momentum on the sell side and now buyers take over. That's not what goes on. That's not how this works, folks. You have to have a narrative. What is it doing? Is it going to go higher or is it going to go lower? Why? What makes it bullish or bearish? That's what I teach you. Relative to that weekly chart. Is the next weekly candle going to expand to the upside or is it going to expand to the downside? That's your number one question. What's going to happen on that weekly candle? You're not predicting the close. You're not trying to predict exactly how high it's going to go. You just need expansion. Okay? Once you have expansion, that means opportunity. And you work within that bias. And if you're wrong and it doesn't go in that, then you're wrong. It's nothing wrong. It's not going to kill you. But once you have that narrative, you stay with it. And you look for all of these little pieces of the puzzle. Because they're not going to hide it from you. They can't. That's the beautiful thing about this. When you understand the state of delivery, and when it changes and then it overlaps where it was a previous state of buy side, and it offers it into sell side, as it's trading down like that, every retail book out there says nothing about buying when it does that. They like to see it when it's already turning. Okay, or they're looking at an indicator. And once it goes down here and hits this, there is a bullish divergence if you look at an indicator right there. That's when they work. But it's not because the divergence is there. It's because the narrative overlaps with what I'm showing you here. The delivery of price controls everything. And it's hinged on time and price. Once you have that and you understand the states of delivery where it's buy side then changes to sell side, when you're bullish, that's where the signals are going to form, because the algorithm will turn on a dime there, like it does here and here and here. None of that harmonic, none of it had this level of precision. But you're learning the highest order of precision there is in these markets, because you're learning exactly what makes these algorithms turn, and when they reprice, and how they should price aggressively one-sided, or how they do it in a sputtering context like this. I'm teaching you how these markets create these choppy but eventual run through. You never learn that in a retail book. You never see that. Folks, I got over 2,000 plus books, and I'm telling you, I've never, ever, ever seen anybody teach the idea of a high resistance liquidity run. It doesn't happen. It does not happen. But you're learning that. What's the benefit of that? You can trade in them, but if you can understand also what they look like here, while they're still profitable, it's better to focus your time and energy on low resistance liquidity runs, because you're going to get that immediate feedback. You're going to get that easy run to your target. Doesn't mean you're going to 100%. It just means that you'll find, in contrast, that that's the easier way of trading. And by knowing what these trades look like, you can filter out your expectation of fast runs while it's like this.